Russia's state news agency, RIA, has issued a major warning. Western countries could lose assets worth at least $288 billion if frozen Russian funds are permanently confiscated. Could it be that the latest sanctions from the EU and the US are now backfiring? Interestingly, the West holds a much stronger hand when it comes to frozen Russian assets. According to recent estimates, around $300 billion of Russia's central bank reserves and other state-controlled funds have been frozen across financial institutions in Europe, the US, and their allies. Here's the breakdown. European banks are holding roughly 27 billion euros, US institutions about $67 billion, the UK has frozen around 37 billion pounds, Japanese banks have blocked 36 billion yen, Canada holds $19 billion, and Australia about $6 billion. Most of these funds are held in foreign securities and banking systems, making them easier for Western governments to identify and freeze. But it's not just state assets. Russian oligarchs have also been hit hard. Their super yachts, luxury properties, and even private jets have been seized. Germany took control of Alisher Usmanov's $750 million yacht and $90 million in property. Authorities in Jersey froze $7 billion belonging to Roman Abramovich. Italy seized a Sardinian villa owned by Nikita Mazepin, worth over $114 million. France and Spain also targeted luxury holdings. In total, around $58 billion has been taken from Russian elites. These seizures were coordinated by a task force called REPO, which stands for Russian Elites, Proxies, and Oligarchs. This task force works across borders to track and freeze these assets. Banks have played a key role in flagging these accounts under legal obligations. When comparing the numbers, the West clearly has the advantage: $300 billion in central bank reserves and $58 billion from oligarchs. But Russia is not sitting still. In July 2024, Russia passed a law that allows the seizure of Western assets inside its borders. This poses a challenge, since unlike Russian funds abroad, Western assets in Russia, worth up to $288 billion, are spread across many sectors and companies, making them harder to target all at once. Still, Russia's threat is being taken seriously. The Kremlin is playing hardball. Western companies trying to exit Russia are now forced to sell their assets at a 50% discount, taking massive financial losses just to leave. On top of that, a 35% exit tax is now applied, more than double the 15% rate from October 2024. This isn't just about punishment. It's also a way to raise cash and keep foreign companies from pulling out easily. Plus, profit transfers have been restricted, meaning companies can't freely move their earnings out of Russia. The goal is to keep that money inside the Russian economy. Russia is also using travel bans on key EU officials, making it harder to negotiate or solve disputes. Big corporations are now feeling the pressure. Carlsberg, once a major beer player in Russia, is under tight government control and facing a forced asset sale. Danone, deeply invested in Russia's dairy industry, saw a former Russian executive take full control of its local operations by December 2024. This problem isn't limited to a few companies. PepsiCo, present in Russia since the 1970s, now faces huge obstacles. It can't repatriate profits and may have to sell assets at a loss. Coca-Cola is in a similar bind, still operating, but unable to move earnings out. ExxonMobil, after pouring billions into Russian oil and gas, had to exit without recovering its investments. Ford, once a major car maker in Russia, is also dealing with possible government takeovers. Unilever, known for food and personal care products, was forced to sell its factories at a loss in October 2024 and now faces near-total restrictions on sending money abroad. In the tech sector, Siemens is trying to sell its assets to avoid possible seizures or heavy taxation. Russia's counter-sanctions are creating big legal and financial problems for international companies. Being forced to sell at steep discounts, paying new taxes, and facing tighter controls makes it incredibly difficult to stay or even leave without serious damage. On a global scale, this is pushing investors to rethink putting money into Russia. It could lower foreign direct investment, and industries like energy and consumer goods, where Russia is deeply involved, may see supply chain disruptions affecting other countries too. This leads to a serious question. How will Western companies plan their future in Russia? Will they adapt and stay under tighter restrictions, or leave a once promising market altogether? Russia seems to be turning inward, relying more on its own resources and reducing its reliance on foreign capital. But will the effects stay within Russia, or could this trigger larger global changes in how corporations operate in unstable regions? By hitting Western businesses where it hurts, Russia is showing it won't give in to economic threats, and in doing so, it's turning a financial standoff into an ongoing economic battle with no clear end in sight.